Well, thank you for joining us for today's webinar, Retirement Planning, Winning by Not Losing. This is the second and special series on estate planning in partnership with the UAB Office of Plan Giving. I'm Greg Berry, Assistant Director in the UAB Office of Alumni Affairs. Just a quick disclaimer, since this is a virtual discussion, please don't be surprised if you hear or see anything odd or if there are any technical issues. If your video does freeze, please use the red panic button at the top of your screen. Clicking that will get your video back quickly so you don't miss anything. This afternoon, we'll be taking a look at how you can set yourself up to enjoy your golden years. Now, before we introduce our guests, I would like to ask a quick poll question. And as I launch that, you will be asked a series of questions, one question, but with 3 different answers. We would like to know how you feel you are actually setting yourself up for retirement. You should see that over on the chat side. Perhaps you believe you're right on track, but you just need a little advice. Or maybe you think you're way behind and have a long way to go. Or you're just doing a bang up good job. We'll leave that up for a few moments here. At the end of today's presentation, we will have time to address questions that you may have. So be sure to use the chat box and get those questions in there. Well, here are the results of today's poll. The vast majority of you, 81%, believe you're on the right track. You just need a little guidance. And the other 2 came in at 9%. So we'll go ahead and continue. At this time, I would like to invite Kimberly Kopic, Director of Development for the UAB Office of Plan Giving, to introduce today's guests.
Thanks, Greg. We are so pleased to be joined this afternoon by a panel of 3 UAB alums, Justin Kraft, Jeff Allen, and Zach Sims, all 3 of Nowlin and Associates. Justin graduated from UAB in 1997 with a bachelor's degree in business. While attending UAB, Justin played a little football, and his sports passion continues. He serves as a board member of the UAB Athletics Foundation. He has over 22 years of experience in wealth management and currently serves as president and co-owner of Nowlin and Associates. Jeff graduated from UAB in 1992 with a degree in finance with a concentration in investments. He has over 28 years of investment experience. He brought his talents to Nowlin and Associates a little over 3 years ago and works as lead portfolio manager. He is passionate about supporting environmental conservation causes. Zach is a Birmingham native who first graduated from UAB in 2017 with a degree in business management. He then went on to earn his MBA from the Collat School of Business in 2019. He also played a little football at UAB and was recently designated New Advisor of the Year for 2019 for Nowlin and Associates. Gentlemen, we're so glad to have you with us. With no further ado, I'm going to turn it over to you.
Awesome. Kimberly, thank you so much. And we're really excited to be here. There's no question that for the 3 of us, UAB is extremely important to us, as is our community. In this city of Birmingham, we are blessed to be in such a great city. And so to be here and to be a part of this, we just thank you guys for the opportunity and the invitation. You know, the first thing I really want to do is start out by just congratulating you guys. What a great job on the poll. The fact that you realize you're taking steps and you're doing some good things and you're setting money aside for your future, whether saving or investing, it really puts you ahead of the game. But to understand that you want to take the time today to invest in yourself and your future, that really is the best investment that we can ever make. I had a mentor that taught me that a long time ago. So I'm glad that we can spend, the next 30 to 45 minutes together. And really quickly, our purpose today is to just talk about a couple of areas for you. We want to talk about what we see are the biggest, what we call money or wealth transfers that are out there today. We're not going to be able to make everyone an expert on those things. Because we're all always learning. But in the next few minutes, we do want to educate you on a couple of things that may have changed and some challenges that are affecting us today. Then we want to inform you of some ideas that you can use to protect yourself and to help your legacy that you're building and working toward. And then the final thing, and I think this is really the most important thing for everyone on here, is hopefully we can inspire you to take action. You know, the worst thing that we can do is stick our head in the sand financially and just say, hey, it's out of sight, out of mind. But if we can give you an idea or two today that you can take action on and put to work for your family or your situation, then the three of us will really deem this as a successful lunch. So looking forward to it, and thank you guys for joining us. So we'll move to the next scenario. I always like to start with, I'm a big quote guy. And one of my favorite quotes is on the bottom here by Albert Einstein, and understanding that things really are different today. Things have changed. The ideas and the strategies that worked 20 and 30 years ago may not be the same things that are working the most effectively today. And here's one of the things Albert Einstein said. He said, we cannot solve our problems with the same thinking we used to create them. And, you know, I don't know about you, but so many times we see that we use old logic and old ideas. And it is so important that we understand that even with our money and our savings and investing, that sometimes we really need to understand what scenario we're in as a family or as individuals, so that we can take that data and that information and make good informed decisions moving forward. So that's what I want to take a look at next. So I just want to take a minute and give you a snapshot about what I'm talking about. If you can see here our current situation and compare it just to 1990, which for some of us doesn't seem like that long ago. If you look at where interest rates were in 1990, the prime rate was 10%. And I think today it's actually around 3%. If you look at our population and the age of our population, in 1990, about 45 million Americans were over the age of 55. Today, that number is knocking on 100 million. So what that means is our population age has really increased with the baby boomer society. And so what I want you to think of as we go into this conversation today is, what kind of impact does that have on you? More and more people are retiring today. More and more people are going to need to access their savings and investings for income. More and more people are going to be going on to Social Security. So it puts more of a strain there. More and more people utilizing Medicare. So it really changes compared to where we were as we look back just 30 years ago. Our tax brackets today, in 1990, the top income tax bracket was 31%. Today, it's 36%. So again, taxes have gone up, and the amount of people that are accessing Social Security and Medicare are also increasing. And then one of the biggest factors that we're gonna focus some time on today is just looking at where we are as an economy and looking at where our debt is. Today, it's over 23 trillion, where in 1990, it was only 3 trillion. So my point in telling you that is the ideas that maybe were working for us in the 80s and 90s may be different than where we are today. So the first thing we got to understand is the data that drives it, and then we can begin to educate ourselves and begin to look at the options of how we can be more efficient in our savings, our investing, as well as our charitable dollars. So here's what I want to do. I first want to start out with an example and really look at it on a household or you and me level. So what I want to do is turn this over to Zach. Zach has just done a tremendous job as he's joined us in working over the last couple of years. He's the pride of Homewood, Alabama, and we're really excited. So Zach, why don't you take them through a family balance sheet and talk a little bit about how that impacts what we're doing as individuals today.
Of course. Well, welcome everybody. I'm Zach Sims, and great to see a plethora of fellow UAB alum on the call. And like Justin said, we're going to run through a family balance sheet. It's actually a family you're pretty familiar with, whether you know it or not, and one that affects your bottom line or how much money you take home. So it's in your best interest to help this family and kind of what they're going through. So if we could, let's go ahead and click through this. So this family, they have an income of $36,000. They have expenses of $47,000, and they actually have debt of just under $250,000. So we've got to take this task of helping this family out and figuring out how to minimize expenses and debt. So we could declare for bankruptcy, not a great option. we could look to decrease expenses. Unfortunately, though, these two options aren't viable options for this particular family. And the reason being is this family is actually the U.S. federal government. So obviously those two options wouldn't work for them. What they can do, though, is increase their revenue. And so let's go ahead and click through what their figures are looking like. They've actually got income, expenses, and debt of the same as we saw on that first slide, but we're going to add an additional 8 zeros to these figures. And actually expenses and debt are probably a little bit higher than what this is showing right here. And income is probably a little bit lower after what we've gone through this year. And so because those first two options aren't viable, we've got to go to that third option, which is to increase revenue. And how does the U.S. government increase revenue? They do so by raising tax rates, taking more out of our paycheck, out of our bottom line. So that's just a quick kind of example or fable, if you will, to show where we're headed and to show that this tax train, it's big and it's fast and it's coming our way, whether it's next month or next year or 5 years from now, it's going to be here soon. So just think about that as we're going through the slides, or the remainder of the slides, and putting a plan together, putting a strategy together to get ready for that tax train. So,
hey, Zach, I wanted to add one thing to that. Greg, could you back up 1 minute, just one slide? So really, I like to show this because, when I hear the news and I hear people talking about, hey, the debt is 23 trillion and our federal deficit is 1 trillion, it's hard for me to understand that. So that's why we try to put it at the you and me level and talk about the family that's making 36,000, but they're spending 47, because you realize there's a big issue there. But when you dig further and realize there's 230,000 on a credit card and revolving debt, you realize how dire that situation is. And so I equate that to where we are today with our federal deficit, because Zach made one great point. It's really difficult for a government to be able to cut expenses. We've just seen that time and time again. However, even if the government sharpened their pencil and decided to cut expenses, they would have to cut it by more than 30%, almost just to balance the budget. And that doesn't leave any room to begin to pay down the debt over time. So what Zach talked about is the one area that they can control is they're going to have to increase income. And if you look at a government, what's the one way they can increase income? Is through taxation. And so that leads us into kind of our next slide, is that there's a gentleman out there that if you research him, I think you'll come very familiar with him. He's a friend of our firm. We've had him on many of our podcasts. We've actually had him in town in Birmingham speaking on more than one occasion. But a gentleman by the name of David Walker, who we'll get to, made the statement that if significant fiscal reforms are not enacted in the U.S., interest rates on the national debt will have to rise and federal taxes could double by 2030. So we're talking about taxes increasing over the next 10 years. Now, you may say, Justin, who is a guy like David Walker to make that claim? And so we're going to talk about in the next slide who he actually is. David Walker was our Comptroller General for more than 10 years and was actually a trustee on the Social Security Board of Administration. So he worked under the Clinton administration as well as the Bush administration. And Comptroller General simply means he was the CPA for our country. And that means no one knows the books, no one knows the numbers or has insight like Mr. Walker. So for him to make a claim like that is really bold. And that's the big point that I want to make to you guys today as we kick this off. I've been fortunate enough to do hundreds of these talks around the Southeast. And I've never had people say to me long term, when we take a poll, Greg, or when we ask the question, I'll always ask, do you think taxes are going to go up or go down in the future after walking through this scenario? And almost 100% of the time, people realize that taxes are probably going to go up. And so if we go to the next slide, you'll see why that is. David Walker in his last talk here said there's a very simple word for why taxes have to go up, and that's math. If more people are using Social Security, if more people are on Medicare, if more people are turning, 55 and then 60 and 65, if our federal debt is continuing to go up, and if you watch the news, there's another round of stimulus coming that's going to add to that debt. Over time, we're not going to be able to pay it all off, but over time, we're going to have to be able to pay for that debt. And the only way to pay for that is through removing deductions or some sort of way of tax rates going up. Even the current tax laws are due to expire in 2025. So taxes are going to go up. And what we have to look at really is what Zach was talking about. How does that increase affect us? So we're going to talk about that a little bit on the next few slides. So the first thing we got to ask ourselves is, where do we store money? Where do we park our savings and investing dollars? And there's really only three places to do that. The first place, we call it tax today. This is where most people are keeping a lot of what we call their safe money, their savings dollars. They're in savings accounts, they're in money markets, they're in CDs at the local bank, or maybe they're in just regular investment accounts that are not tied to an IRA or a 401k. What that means is these are monies that are taxed each and every year. Any interest you earn on that CD, you get a 1099, and you're having to pay income tax on that. So the second bucket that we look at, we call it tax deferred or tax tomorrow. These are dollars that you're putting away in a place to defer taxes, but you're going to have to pay those taxes somewhere down the road. So if you look at your 401k or your IRA, or maybe you have some retirement annuities, those are dollars that you're not paying tax on today. However, what a lot of people don't realize is when you pull those dollars out, you're going to be taxed at your ordinary income rate. So one of the things we have people think about, and this is where thinking and understanding where we are come into place. In the 90s, tax rates were lower, and the whole idea was defer as much as you can in these qualified plans, because down the road, when you pull it out, you'll be in a lower tax bracket. Well, now tax brackets have gone up, and they're projected to go up further in the future. So that idea is, if we defer a tax dollar today for the privilege of taking it out down the road in a higher tax bracket, how does that impact us? And we are certainly not saying don't save money in 401ks or IRAs. Absolutely, you want to take advantage of those. Those are one of the first places that you look to park money. But what we're saying is we may want to think through that. What if there's money we're putting in and we're not getting a match on? Are there some other alternatives and ways to be more tax efficient where we could park money in what we call the third bucket, which is on our next slide, which are tax free, which is hard to say, or tax advantage. So there are things like Roth IRAs or properly designed life insurance contracts, municipal bonds. There are giving strategies that can help you offset converting some of your tax deferred money in IRAs to more Roth options that are not taxed in the future. So what we talk about is, how can we, instead of loading up on one of these three areas, how can we check the boxes in each one? How can we have taxable accounts to keep some of our safe money? How can we build some longer term money where maybe we're taking more risk and utilizing the stock market, which Jeff's going to talk about for our longer term dollars? And then how can we begin to build a third bucket in one of those three areas where we don't necessarily have to worry about tax rates going up in the future? And so again, if we're going to diversify our investments, we also need to diversify the types of tax accounts that we're storing money in. So this may be a new idea for you. So I challenge you to write down a few questions and research that as we move forward. So one of the ways that we are seeing now more than ever people taking advantage of these options and understanding that we are in a lower tax bracket than we were just 3 or 4 years ago, and understanding that those may expire in a few years, is they're looking at charitable giving options. And so one of the these are some of the ideas that we see that are most common for us as we partner with our clients and looking at ways that they can maximize their tax strategy, but also maximize their giving dollars to create a legacy and to really do some good things out in the community. We've worked a lot with people right there at UAB. And so I challenge you to look at some of these options and see how they might fit for you. The first one and most common way of giving is a lot of our clients are gifting appreciated stock. So maybe in a taxable account, so one of those that's taxed today, you might have bought some Apple stock maybe 8 or 10 years ago. And first of all, I say kudos to you because that's done pretty well, right? So as that stock appreciated, it may be time you want to make some charitable contributions. So one option is you can just write a check and give cash, but another option that can help you be just a little bit more tax efficient is you may be able to gift that appreciated stock right to the charity, right to UAB in this example. And they're more than happy to take that. And we work through that time and time again. You're able to deduct that up to 30% of your adjusted gross income. So I'll tell you now, we're not CPAs or tax attorneys. Our job is to work as a team with your CPA, with your tax attorneys, and with the charity of your choice. So definitely check all that out. It has to be done the right way. But this is one of the most common ways that we see people taking advantage of tax strategies in order to meet their charitable goals. Another way that really fits in with your planning is number 2. And this is while we're in what is considered by David Walker, our former CPA of the country, to be a lower tax environment for the time being, we're seeing a lot of clients really get creative and want to take traditional IRAs, convert those to a Roth while we're in lower income tax brackets. But then to offset that, you can then make a donation out of your savings or out of your cash to a charitable organization that offsets that tax. So think about it this way. You take part of your traditional IRA, you transition it to a Roth. There's a tax bill on that. Then you make a gift or a plan charitably, and that what that does is a deduction for you that you're able to offset the tax on that transition. And now you've taken a tax deferred asset and moved it into a tax advantaged or strategically a tax-free asset. So those are some really good, just quick planning ideas. Again, you need to see how that works in your financial plan, and you need to be working with your CPA, but there may be some advantages to looking at doing that. The third thing we see, and I'm not going to take a lot of time, but if you have a complex asset, maybe you own a privately held company or you have some highly appreciated real estate, get with Kimberly and their team at UAB Plan Giving, get with your advisor, and there are some strategies to take some of these illiquid assets and be able to donate those because you have a very, very low, what we call a tax basis in those. So those are some really good ideas that can fit into an estate plan and can work well in a tax planning strategy. One that we've done a lot with lately is people that are in retirement that have built up retirement savings. Sometimes as they're looking at leaving a legacy, they can donate matured permanent life insurance policies to a charitable organization, and it removes that asset from their estate. So again, I'm not going to spend a lot of time on it, but my job is just to spur ideas for you and give you some things to consider. And then one area that we've seen become really popular lately in the last couple of years is what's called a qualified charitable distribution from your IRA directly to a charity. So as we go to the next slide, I wanted to touch on that one for a minute because it really has become very, very popular. So again, you need to consult your tax advisor, but this is a great planning strategy. So through the CARES Act, we call it a QCD, a qualified charitable distribution. It will allow you, if you're over the age of 70 and a half, to donate up to $100,000 in your IRA assets directly to a charity of your choice. Here in this example, we use UAB, and it doesn't add anything to your taxable income. So in the past, if you donated it, you had to recognize it as being a taxable distribution. And so through some tax planning and legislation passed a few years back, you can now take up to $100,000 and donate that directly to a charity. Well, let's say you're not 70 and a half. Even in some of the provisions of the CARES Act that was just passed recently, back in the spring, it will allow you to deduct 100% of your AGI, stands for adjusted gross income. So again, these are ideas that we can dig into. We're not going to make you an expert on those today, but our objective as a team, I just wanted to bring to you some ideas that can help you not only with your tax planning from an investment standpoint, but also for your legacy planning and to make sure that you're accomplishing the things you want to with your charitable giving. So take advantage of those ideas, and we're here a little bit about later in the program some ways that you can do that. So really the next steps from that is I want you to understand how taxes impact where you're saving and investing money today, and then talk to your advisor. Those are the next steps, and understand what are some options you can do, and then get with UAB Plan Giving today and explore those ideas and opportunities and see if they might be a fit for you. So as we go through this, remember our two goals. We wanted to talk about taxes. That's one of the largest eroders of wealth that we see today. And the second thing that people are very curious about is obviously investments and investment losses. And one of the things I'm going to say before I bring Jeff on, Jeff's been managing investments and been a wealth manager now for over 28 years. And we're very excited that he joined our team and heads up our investment committee. But one of the things that we're really, really excited about is that understanding that there are strategies and planning tools to help you. So many times in our industry, you'll hear people say, well, hey, look, we need to just buy and hold. And then I hear the words, I hope my investments don't go down. Or we hear the idea, I hope that they come back and that they rebound. I hope the stock market goes up before I retire. And one of the things I've learned in 22 years, and if you don't take anything else away, I hope you take this one point away. Hope is not a financial strategy. What we need is true data-driven, mathematically based ideas and concepts that can help put the odds in our favor with our investment plan. And we're going to bring Jeff on to touch on how we do that and how you can make the odds work in your favor. So Jeff, take it away.
Yeah, thank you so much, Justin, and thank you, fellow Blazers and everybody else on the call. And when I graduated UAB in 1992, I was very, very fortunate to get hired by a major Wall Street investment firm and started my career in Palm Beach, Florida, doing this. And how I was managing money at that time was I was just taking the analyst recommendations, our so-called experts at the firm in New York City, and calling on my clients, telling them to buy IBM and sell Intel, sell Coca-Cola, buy Pepsi, etc., with not much success at all. And then I was very fortunate to gain a client down in South Florida, and his specific instructions to me when he opened up an account with me was, Jeff, do not call me with your firm's recommendations. I will call you, tell you what to buy, and tell you when, and tell you when to sell it. Well, after about a year in my career, I saw the pain and the hope that I was having in my analyst, and then looking at my other clients' accounts, I was making his own recommendations and how successful he was. And I finally got up the courage to give him a call and asked him, what are you doing that's so different? A lot of times it's almost the exact opposite of what my experts are doing. And you take losses, but you're taking small losses. And if you have something working for you, you let it go. And my analysts are saying, go ahead and take the profit. Well, he was very happy that I made the call and told me that he would like to introduce me to a family friend. So this good old Alabama boy got on an airplane with my client, and we flew up to New York City to meet a family friend of his. And so we went and met this individual. His name is he's passed away, Michael Burke. And Michael Burke was head of the research at Investors Intelligence and Chartcraft. And the main thing that Mr. Burke taught me was there's two different types of analysis. The one that almost everybody's very familiar with, fundamental analysis. That's the analysis of how much the company is earning. How much revenues do they have? What do their properties and their assets, their employment contracts, all of the nuts and bolts of a company, which are extremely important. But he also taught me that there's another form of analysis, and that's technical analysis. And technical analysis is really the study of the psychology of the markets, the supply and demand. So many people try to make investing so complicated, but if you can go back to, if any of you went to the business school, open up that first chapter in Economics 101, and supply and demand is so important, and that's where technical analysis is studying the supply and demand of these securities. The type of technical analysis that Michael Burke taught me is called point and figure charting. And if you could go to the slide that's got the book Point and Figure, yeah, one more. I think there we go. So Michael Burke learned this form of technical analysis, which is a form of risk management and trying to get the math in our favor, because so much of investing, you can get the math working against you. So it's so important to protect your assets and get the math in your favor. So Mr. Burke learned point and figure charting, point and figure technical analysis from an individual by the name of A.W. Cohen. He wrote some books on it in the 1940s and 1950s. Mr. Cohen learned it from somebody, but then Mr. Cohen, goes down, through the lineage. But the most important person who really invented this form of analysis is an individual by the name of Charles Dow. Charles Dow was the founder of the Dow Jones Industrial Average. He's the founder of the Wall Street Journal. The Dow theory of investing is named after him. And if you could go to that great picture of Mr. Dow, I mean, Mr. Dow was way before his time. Now, you look at Zach, almost everybody looks. That's
he kind of looks like Zach.
Yeah, doesn't he though? So that he Charles Dow created a couple of trends. One of them is the new Orvis look. It's again a great quote here. Pride of opinion has been responsible for the downfall of more men on Wall Street than any other factor. Things have changed. Tax rates have changed. The national debt has changed. We're talking about a lot of change, but yet there's a lot of things that are still the same. And this quote, it was very, very important in the 1880s when Charles Dow was, doing the studies on point and figure charting. And it's just as important today, whether, you're watching Jim Cramer jump up and down and hit the red button and screaming buy or sell or whatever, that's not good. That's not a good strategy. You really need to come up with a good strategy to get that math in your favor. And how Charles Dow did this was he was sitting at his desk and on big pieces of graph paper. And if you could go to that next slide, please. This kind of looks confusing. Like, what in the world is this X's and O's tic-tac-toe board, which my daughters used to call it when they would help me with these charts. But what Charles Dow would do, and again, it's taking a very complicated subject and simplifying it. For each point that a stock would go up, he would put an X. And then for each, the stock would start to go down over the next week or the next month. For each point that it went down, he would put an O and then start to go back up an X. So you kind of see a pattern starting there. And if you would go to the next slide when it has a bunch of patterns on it. So what Charles Dow's study, A.W. Cohen studies, Michael Burke studies, my studies, a lot of other people that use this strategy, what we start to find is with this crazy X's and O's back and forth action, that different patterns will be created. And we have found that, if you look on the left-hand side, those are some examples of some patterns that the chances of success, not hope of success, but chances of success are very, very high. But yet on the right-hand column, we have found that if you, sit there plotting these X's and O's, that if we start to see certain patterns, that the chances of the securities or the market itself, the chances of it going down are extremely high. And if you look on that bottom left-hand corner of the bullish side, that is the main strategy, the main pattern that we use for our risk management in our portfolios, and that's the trend line. And we follow that trend line, and if a stock breaks that trend line, we're going to take a loss on the portfolios. We're going to protect those assets because, again, with math working against you in so much of investing, what most investors do, whether it's a private investor and, unfortunately, a lot of professional money managers, they'll take an example of $10,000. They'll invest in a stock that's at $100 a share. It goes down to 90. They just kind of shrug their shoulders. Oh, well, it's good at 100. It's even better at 90. It goes down to 80. They start sweating a little bit. It goes down to 70. Well, and then that hope starts coming in. Well, I hope it comes back. It goes down to 60, and they're like, oh, no, I'm going to have to tell my wife that I bought this stock and we're down, all this money on it. Then it goes down to 50, and they finally panic and they sell. Well, if you look at what this individual did, is they took $10,000 and now it's 5,000. That's a 50% loss. But many people think, well, I just have to make 50% on the next one to get back to even. No, do the math. If you go from 10,000 to 5,000, a 50% loss, you now have $5,000 worth of capital to get that 5,000 back to 10,000. So you need a double in your money just to get back to even. Where in portfolio management, if you keep your losses small, don't be afraid to take losses. You know, for an example, we like to use 8% as a rule of loss on any security. So if I drop 8% on a security and I sell it, the next stock that we buy in our portfolios only has to go up by 8.7% to get back to even. And that is extremely, extremely important, is keeping your losses small and protecting those assets. One stock, I can give you a great example of how that trend line is so important. Many of you have heard of Enron. If you go to the next slide, please. Enron was a very big corporation, a very darling of Wall Street, so to speak. All of those experts at the Wall Street investment firms love this stock all the way down. They were saying buy it, buy it, buy it. CNBC, you know, saying nothing can ever happen to this stock. But as you see, when the stock broke that trend line, you know, which if you look at that closely up towards the top of the chart where it broke that dotted line going at a 45-degree angle from left to right, once it broke that, the institutions came in and they started selling, because, you know, it's not Mr. Smith down the street selling his stock, you know, buying and selling his stocks that move the market. It's the big institutions. If they have their finger on the buy button, stocks are going to go up. If they have their finger on the sell button, the stocks are going to go down. So this is a great example. If you kind of flip through these slides kind of quick, you'll see kind of an animation of, you know, when the stock started breaking that trend line, the institutions came in and down it went. And I could overlay stocks from the Great Recession, Washington Mutual Bank, Lehman Brothers, Bear Stearns, you know, our local bank in Alabama, Colonial Bank. You could overlay those charts during that bad time and they look exactly like Enron. So the key to investing is not let those stocks get into your portfolio. And if they do, you know, fire them, get rid of them right away. So the first thing that we look at in building the portfolios, and that you should look at, is what are the institutions doing? What are the mutual funds? The life insurance companies that are managing stocks. You know, again, if they have their finger on the buy button, you know what? We're looking to add securities to our portfolios also. That's our green light. If we're starting to see some institutional selling come in, we go to a flashing yellow light, which means, okay, let's be a little bit more cautious. But like in the end of February, first part of March of this year, the institutions had their finger on that sell button and they were just selling indiscriminately a single stock that they had in the portfolio. And what happened when the institutions do that? You had a market drop 35% in a matter of 2 months, 2.5 months, which is absolutely frightening. But luckily, the market has bounced back. When a market drops 35% or more, on average, it takes 47 months for the market to get back to even. It didn't happen this time. It was only 4 months. Now, is that healthy? You know, only history books will tell, but we need to follow the institutional money when we're managing the money in the.
Hey, Jeff.
Yes, sir.
Hey, I wanted to come in because we've just got a couple of minutes left, and I wanted to summarize and help me real quick. So
Sure.
when you think about this, for everyone that's listening, as opposed to just bringing in that idea of, hey, let's just pick some good mutual funds or some good stocks, what we're talking about is bringing in true common sense, data-driven solutions that help us not only recognize fundamentally really good companies that have a good balance sheet, that are managed well, that have a history of doing well, but also overlaying that, what you referred to that a lot of people haven't heard of, is the technical analysis, to where we can get in line with the stocks that the institutions who are moving the markets that they can buy, as well as understanding that when the math's in our favor, we're buying. However, if the institutions begin to sell that security and the math's not in our favor, there is data-driven techniques in order to get that position out of our accounts. And so what we're able to do there, and I know we've got to get on to some questions here, Jeff, in just a couple of minutes. I'll throw it back to you to wrap up. But really what that allows us to do is it removes some of the emotion and makes sure that we have a process. And that's the thing that I think has impressed me so much with this strategy. And I really want our people out there hearing is to understand you need to have a process. The emotional sides of the market can really, really hurt you if you make a decision based on hope and based on emotion. But if you have a process that puts the math in your favor, then more times than not, you'll be on the right side of your decisions. And that's what your job is. But go ahead and let's wrap that up, and then we'll get to some questions.
Yeah. Like Justin said, it's kind of, you got to have a strategy. And, if you go to the next slide, we kind of put all of these things that we have talked about. The fundamental analysis, take the market, let's take 6,500 stocks. We run it through through filters. So we're narrowing down 6,500 stocks to 250 stocks to get the fundamentally strongest stocks. And then we're just overlaying. If you kind of go through the next slides for me. So, we look at the economics, then we overlay it with the market direction. Then we overlay it with fundamental analysis. And then we overlay that even more with technical analysis. And you have to have all four of those factors when I'm running the portfolios working together to get that magic point. You can't have 2 out of the 4. You can't have 3 out of the 4. We need all four of those factors overlapping each other to get to build a big portfolio, and then protecting it on the downside. One of the people that I really follow in investing, he was the Warren Buffett of his time from the late 1800s, and really helped our presidents through World War I and through World War II with economic policy, was Bernard Baruch, who had a strategy very similar to this. If you go to the next slide, he's got a great quote for him, and this is so important. If you look at all of the market mavens of Wall Street over time, they all have this same philosophy, and that is, in trading and investing, is not how much you make, but how much you don't lose, and that is so important.
That's awesome. And Kimberly, before I turn it back over to you and Greg, if we go to the next slide, I think it's so important to ask yourself, so what do we do with all the information we heard today? And the number one thing I say is get with your advisor, get with someone you trust, and make sure, this is a word that my team hears me say over and over, and you may be sick of it. For taxes, make sure you have a strategy. Don't guess, don't put your head in the sand. And for your investments, make sure you have a strategy and you have a plan. This may not be exactly the right one for you, but whatever you're doing in your taxes and your investment planning, make sure that you have a strategy. And the biggest thing and that's why we named it what we named it, make sure that you're positioning yourself to win by not losing. It was awesome to be with you guys today. And Kimberly, I'll turn it back over to you. And then I think we do have a couple of questions, you and Greg.
We do have some questions coming in, and feel free to submit more questions as well. We'll start off with, can you only convert a traditional IRA to a Roth? I have a beneficiary IRAs, and I would like to convert them to the Roth IRA.
Yeah, so that's a great question, and that's something that will involve your tax advisor. It adds a step, and it is a little more complicated, probably be hard to get into, but the answer is, can it be done? And the answer is yes, but there's a couple of extra steps to that.
On the same vein, can you convert it over a few years, or does it have to be kind of all at once?
No, you can convert it over years. It really depends on, there's a strategy to that based on your income, and there's some tax planning that you would want to do.
So we have a person who is struggling with how much they will need for retirement. Is there an Excel formula that can help you out to see what you're going to be having and living comfortably with?
Yeah, so that is a great question, and there's so many unknowns in that. One of the places that we start, and again, these are those rules of thumb that we hear, is look at the income that you're living off of today. And then what you want to do is project that forward with a little inflation rate. And then you can plug in how much you're saving and investing and how long you have. And that's one of the things an advisor will do for you is actually put a plan together. There are some simple calculators that are on the internet. There are several that you can go to and put in these kind of projections of, hey, here's the income that I'll need in retirement. But that's where partnering with a financial advisor, having a plan and a strategy, and they can help you get there. And again, make sure the math's in your favor.
So investment strategies range from safe to very aggressive. For someone in their early 30s, what would you suggest?
Yeah, I may let Jeff jump in and help me here, but I would certainly start out by saying, number one, you need to understand your comfort level for risk. If there's one thing that I've learned in 22 years, there's not a one size fits all financial plan. So everyone has a different comfort level for risk. Obviously, if you have longer before you need to access the money, then you can afford to be a little more aggressive. But Jeff has taught me, and we've learned over the years, there is never a reason to take additional risk if you don't have to. So if you can get to the same place by taking half the risk, then doesn't it make mathematical sense to do that? And that's one of the things that Jeff does well. If we can be in the market but have a strategy that reduces a risk 30, 40, 50% and still get the same expected outcome, then we're smart to be able to do that.
Yeah, and I call it the sleep factor. I mean, we've all seen in the textbooks, and we've seen, all of the calculators on the internet. A lot of strategies are, if you're 50 years old, have 50% in stocks, 50% in bonds. If you're 30 years old, 70% stocks, 30% in bonds. But you may have somebody that just isn't going to be able to sleep at night. They're not going to be able to have that comfort of having 70% in stocks and 30% in bonds, even though the textbooks say you should have. So it really comes down to what's going to make you comfortable, what's going to make you be able to go on with your life and enjoy life by taking the amount of risk that you have. So there's no real right answer for somebody's age and their income. It really comes down to your feelings and what's going to keep you awake at night.
We have somebody that was late to the party investing in IRA. Can you catch up tax deferred on previous years?
I'm sorry, I missed part of the question.
Somebody was late to the party for investing in IRA. Can they catch up? We just had another question, so it bumped it down. Can they catch up tax deferred savings for years prior?
Years prior in an IRA? That would be something I'd have to consult with our tax advisor. There are catch-up provisions after the age of 50 where you can contribute more to an IRA, but I'm not aware. Nothing jumps out to me. Jeff, Zach, anything there? I don't think there's a catch-up provision for IRAs. No.
When moving money from regular IRA to a Roth, is the amount treated as ordinary income for that tax year, therefore moving you into a higher bracket?
Correct. And that's why you want to have tax planning and a strategy, understanding, maybe this year with the impacts of COVID-19, perhaps income is down this year compared to normal years, or even one of the strategies we talked about before when we gave those 5 ideas. It may be a year where you want to enhance your giving. Maybe you combine 2 or 3 years of your giving in the same year that you convert so that additional tax can be offset by that gift. And that's something where Kimberly and your advisor and CPA, we can all work together and maximize that for you.
Somebody has heard that they should steer clear of permanent life insurance, but this is the second presentation that they've seen recently where it's been mentioned. What scenarios does permanent insurance make sense, and is the perception of it changing?
I don't think that the perception has changed. What they're hearing, I tell people we're in the right ballpark, but we're playing the wrong game. So traditionally, life insurance is bought for a death benefit, right? And so insurance companies charge as little possible for that death benefit to still make it viable. What it has to do with is the structure of the life insurance policy. So if you're utilizing it to build up a savings vehicle as part of your financial plan, then what you want to do is do it opposite. You want to fund as little life insurance as possible and put in the maximum amount so that the expenses of the death benefit are not eroding your return. And so one of the best examples, and for you guys can go out and Google that, one of the largest purchasers of this type of specially designed insurance in the country today are the banks. It's called BOLI, BOLI, stands for Bank Owned Life Insurance. And so what you do is there's actually some tax guidelines, and that's where an advisor can help you. You want to get the death benefit as small as you can, and then put in as much as you can based on your ability to contribute and your need for insurance. And then you're building up what can be something very similar to a Roth IRA lookalike with some tax advantages built in. So insurance is a great planning tool when you move beyond the Roth IRA.
We have somebody that recently retired and they have a good size 401k balance. Compare and contrast the advantages or disadvantages of converting this to an IRA.
Converting a 401k to an IRA. Yeah. So really the advantages, so if you leave it there in your 401k, you're going to be able to invest it in the funds that are offered in your plan. So typically most 401k plans have anywhere from 20 to 50 investment options. However, rolling it into an IRA with the right advisor, or even if you're managing it yourself, as Jeff talked about before, you've got 6,500 individual stocks and you've got double that amount in individual mutual funds. So instead of finding the best mix that's inside your 401k plan of 20 to 50 scenarios, you can now find the best of the best that are out there. And you're going to have access to over 15,000 mutual funds and 6,500 individual stocks. So my point is, it gives you many more options. The second thing is, a lot of times there are built-in expenses that you don't see inside of a 401k plan, that by rolling to an IRA, you may have the opportunity to be more efficient in your expense ratio. There are some downsides depending on your age. Certain 401k plans, you can access money before 59 and a half. If you leave it in the 401k, those are provisions in the plan. Most plans don't have it, but some of the bigger ones do. However, there's no difference if you're over the age of 59 and a half, except to me, you have more investment options and opportunity for a lower expense ratio. So I think it's beneficial in most cases.
When it comes to portfolios, do you want to have more of a broad portfolio, or do you want to have more narrow?
So I've talked a lot. Jeff, why don't you jump in there? You got a thought on that?
I mean, diversification is a wonderful, wonderful thing. But in my opinion, and this is just my opinion, there's a such thing as over diversification. Everybody's heard for years on years and years that mutual fund managers almost always underperform the market. They underperform the indexes. But by prospectus, part of the, that main reason is they have to be so diversified and have hundreds, if not 1,000 different securities. Whereas if you could take a portfolio manager, mutual fund managers, say top 10 or top 20 picks, and then looked at his performance on just those, most managers would really outperform the market. So Stanley Druckenmiller is a big hero of investing. One of the great hedge fund managers of all time has a saying is, buy a small basket of stocks, but watch that basket really, really close. So I like a smaller, more concentrated, but again, with my strategy, if something's not working, we're going to get rid of it, sit in cash, or replace it with something that's performing better.
Very, very good information from all of you this afternoon. So we greatly appreciate.
Hey, Greg, could I add one thing real fast? I wanted, and I appreciate my colleague texting. I just want to be sure we're giving accurate information. One of the questions was about an inherited IRA. Can you convert it to a Roth? And I just assumed, and you should never do that it was a spousal inherited IRA, which you can convert to a Roth. However, it is much more difficult if you're inheriting that from a parent or a grandparent. So I wanted to be sure and make that clear when I said always consult your tax advisor.
Gotcha. Thank you so much for that clarification. And Justin, Jeff, Zach, thank you for joining us today to discuss things we need to consider when we're thinking about our retirement plan. Thank you so much, guys. Just a heads up to our audience, a recording of today's webinar will be available online. And now with more information about the UAB Office of Plan Giving and how they can help you, I would like to turn things over to Kimberly Copping.
Thanks, Greg. So my role at UAB is to help facilitate estate gifts to the university. Retirement assets can be a powerful and tax-efficient way for you to support the UAB program or area that means the most to you. I've certainly seen firsthand the impact that using these assets can make, from supporting scholarships to supporting research to supporting our athletics. If you're interested in learning more about how retirement assets can be put to work at UAB, making the impact that you want, please don't hesitate to reach out to ask any questions or to have a deeper conversation. Thank you.
Thanks, Kimberly. Well, if you're looking for an alumni podcast, check out UAB Green and Told. Episodes drop every other week and feature members of the UAB community. This week's guest is UAB head football coach Bill Clark. You can find the podcast on Spotify and iTunes, or visit alumni.uab.edu/green and told. And we would love for you to join us on November 8th for Uncork Education, an evening of jazz with Eric Essex from the Alice Stevens Center. Through 11 years of Uncork, the National Alumni Society has been able to raise more than $500,000 to go to scholarships. This year, we're going to have to go virtual, but we have plenty of support levels for everybody. Be sure to check us out at alumni.uab.edu/uncork. Be sure to stay on top of all things alumni on social media. We are at UAB Alumni on Facebook, Instagram, and Twitter. You can also look us up on LinkedIn by searching UAB Alumni Career Community. Finally, if you want to get in touch with us in the Office of Alumni Affairs, the National Alumni Society, you can email alumni@uab.edu and check us out online at alumni.uab.edu. Once again, thank you for joining us for today's discussion with Justin Kraft, Jeff Allen, and Zach Sims. Have a great afternoon, and go Blazers.